If we have much lower oil prices, we're not going to have a lot of new production. See, that's the problem. You can't afford to produce oil if the price goes way down. People are saying, oh, we're going to have $40 oil. We're going to have all this new production. If oil's at $40, no one's producing oil. They're going to lose too much money. In fact, if you look at the CapEx plans, oil companies are planning on spending less, not more, because the price is already too low. I do think that we'll have more drilling under Trump, but it's going to be because oil prices are much higher. That's what's going to support it. That's what's going to make the drilling possible, is going to be much higher oil prices, not lower oil prices. So we're not going to get a big tailwind of the economy from super cheap oil. Oil is bottoming out. So oil is going to start out when Trump comes in, it's $70 a barrel. I think it's going to be well north of $100 a barrel when he leaves. In fact, it could move up about to 100 during his first year. So that's going to basically take the wind out of the sail. And that's part of, the Treasury Secretary's, his 3-arrow plan that he's got borrowed from Shinzo Abe. But Scott Bessent, one of his arrows, or his, whatever he's called them, is cheaper oil. That's supposed to, keep inflation down. Well, it's not going to happen. And again, oil prices don't drive inflation. It's the other way around. Rising oil prices don't cause inflation, but rising inflation causes rising oil price, or more inflation. Not right. The creation of inflation will drive up the price of oil and the price of everything else. And that's what's going to happen. But we're not going to get the cheap energy. We're also not going to get the spending cuts that he is hoping for. And, we're in fact, we're going to get the opposite. We're going to get increases. The main driver, just the interest cost on the national debt. And the problem for the government now is with long yields rising, now that the 10-year and the 30-year are all higher than the short-term rates. The Fed is not going to sell 10-year treasuries. They're going to be financing at the T-bills. And so what that means is that over the next couple of years, Trump is going to be considerably shortening the average maturity on the national debt, making that ticking time bomb that much bigger. Because ultimately, when the Fed loses control and has to raise long-term rates, which is short-term rates rather, which it's going to eventually be forced to do, that's going to be particularly problematic for the government, because now so much more debt is going to be rolling over. And now it's going to have to be refinanced at much, much higher rates than, 4.5 or whatever they're financing it at now. So you're going to see the net interest cost exploding. I hear a lot of people, they think the debate is, Trump's going to create all this extra economic growth. We're going to have a stronger economy, and that's going to put the Fed in a difficult position because it's going to be putting upward pressure on inflation. And is the Fed going to hike rates in the face of the strong economy? I think they've got it half right. It's not going to be a strong economy. It's going to be a weak economy. The economy is going to be weaker. Yes, we're going to be spending more. There's no question that people will spend more, right? If we have increased government spending, if we have tax cuts, we're going to spend more. But we're not going to be producing more. The trends in manufacturing are going to continue. The trade deficits are going to get bigger and bigger. And so the real economy is going to be getting weaker, just like it's been in the past. What's going to strengthen is inflation. So it's not going to be that we have this booming economy and the Fed might hike. It's going to be that we don't have a booming economy, but the Fed might have to hike anyway because we have a resurgence in inflation. And in fact, it's very possible that even before we have a chance to get the tax cuts, that we officially go into recession. We could see a big move up in the unemployment rate. Now, the real question is, will Powell ease? Will he continue to cut rates to try to prop up the economy, even if inflation is headed in the other direction? Because nobody is talking about that possibility. Everybody just assumes that it's one or the other. That if we have a weak economy, well, then we don't have to worry about inflation. And if we have so the only way we have to worry about inflation is if the economy is stronger than expected. And people think that's still a problem. But what they're overlooking is the much bigger problem if we get stronger inflation and a weaker economy at the same time. And the reason that's the worst possible problem is, of course, it's the one the Fed has no contingency plan for, right? They admitted that. All they can do is hope it doesn't happen, because if it does happen, they're screwed. And of course, if they're screwed, the country is screwed, because there's nothing that they can do when they have a problem with both of their mandates at the same time. They like to say, look, we're trying to get full employment and stable prices, which they've redefined. In fact, I even heard Powell at a recent, his recent Q&A say that, Congress has given us these mandates for 2% inflation. Congress never gave the Fed a mandate for 2% inflation. The mandate is for stable prices. 2% inflation is BS. That's not stable prices. That's prices going up 2% a year. What's stable about that? Stable means they're unchanged. That's price stability. If Congress wanted 2% inflation, they would have put that in there. The Fed came up with 2% all by itself. It decided to define price stability as 2% inflation. So if it could define it as 2%, it could define it as 3% or 4%, whatever the hell it was. But that's not what it's supposed to do. But anyway, if it has this one mandate for 2% inflation, and then it has full employment, and it always wants to see, right now the unemployment rate is really low. And of course, it's only really low because of the way they calculate it. And the only reason inflation is low is because of the way they calculate. If they calculated inflation and unemployment honestly, the Fed would be failing on both mandates. You would see that unemployment is actually very high right now, historically high, and so is inflation. And so the Fed is a two-time failure. Instead, the Fed pretends that they've succeeded because they've rigged the game. But despite the fact that they rigged everything, unemployment and inflation can still be so bad that they can't hide it, right, between these numbers. And so once they get a spike in unemployment and a spike in inflation that happen at the same time, they got nothing, right? And they have to make a choice. They're caught between a rock and a hard place. And, when you hear people saying that, oh, it's very rare to have recession and inflation at the same time, it's not rare. It happens all over the world. It just hasn't really happened in the U.S., in a big way since the 1970s. And part of the reason is because, we've changed the way we measure it. If we measured it correctly, we would have seen that we've had stagflation for a while in this country. But it is the norm. I mean, normally, when you have a weak economy, you get inflation, right? Strong economies don't create inflation, right? Why should a strong economy create inflation? Inflation is a bad thing. You don't get a bad thing from a good thing, right? That's what the government wants you to believe. But a strong economy is productive. You create more stuff. That lowers prices, right? Strong economies have high productivity. That keeps prices down. And if you look historically, you look around the world, you look at the strongest economies in the world, they have the lowest inflation rates in the world. It's the weakest economies that have the high rates of inflation, right? So inflation is a problem that weak economies face, not strong economies. Why do you have inflation in weak economies? Well, one thing, the economies aren't as productive. They're not making as much stuff. But why are economies weak? Generally because the governments are too big. They're spending too much. So they're printing too much, right? They're running deficits. Governments create inflation, and inflation weakens an economy. So you normally have inflation and a weak economy at the same time. It's not some rare combination that rarely happens. It's the norm. And so that's what we're going to have.